This is Jeremy Squire on behalf of Wealth Associates Asset Management, reporting back to our clients on our portfolios, performances and market developments over the year to date. Those of you who follow your portfolios closely will have noticed that the last 3 years in particular have shown very sideways movement at the growth end of the market. And this is largely based on uncertainty both locally and internationally, and it makes it extremely difficult to eke out the targeted returns, particularly in the balanced and the growth portfolios, because the growth areas of the market have been somewhat muted. As an example, the JSE year to date, there's only one sector which has actually shown positive performance. That's the Resources 10 Index. And that's shown a gross return to date of 15.6% annualized. Conversely, the Industrial 25 is 6.2% down, Financial 15, 8.6% down, and the All Share is 4% down. Something like property, the property index, which has been a bellwether of consistent returns over the last 10 years, is 24.4% down year to date. And that is just symptomatic of the difficulties in the market. Now, normally this would be something that would happen when there's been a big event which has actually caused markets to drop. But in fact, what we see is that over the last 3 years, it's actually just been a sideways movement. And it's very largely based on the uncertainties of the Zuma years. It's also based on the uncertainty created by Trump and the international trade wars. And until certainty returns to the markets, growth markets will probably struggle. Having said that, there's tremendous value that we see at the growth side of the market, and the most important thing for clients is to make sure that the strategy that they and their advisors have put in place is actually maintained, because the natural inclination of clients would be to actually sell out of the growth assets and invest in the cautious money market side of the market. But that's what we call market timing. And the reality is that doing so, particularly when your strategy is correct relative to your personal risk tolerance and time horizon of your investment, it's the worst possible thing that you could do, because then you're actually confirming the sort of negative or muted returns of the market. And what we find is that when markets do rebound, I'm never sure when that will happen, but when they do rebound, then the actual returns that one gets tend to be fairly impressive. If one considers the matrix of returns in the local South African market, there's a huge variability in terms of the actual performance of the different asset classes. And this talks to the importance of diversification, because every one of the portfolios is well diversified across these asset classes. And that's an essential component in terms of protection of capital, but also optimizing the risk-return relationship within portfolios. Within the four Wealth Associates risk profile portfolios, the construct dictates that the cautious portfolio would give you the lowest risk and therefore the lowest return over a period of time, whereas the growth fund would give you the highest return and higher level of risk over a measured period of time. Let me say that each one of those portfolios, when we talk about risk, the risk within each of those portfolios is significantly less than market risk because of the diversified nature of the portfolios. But as an example, if we look at it, the growth portfolio over a 3-year period has shown an annualized return of 4.5%, whereas the cautious portfolio has shown 7.72%. And over the last year, the growth portfolio is 6.09% and the cautious portfolio is 7.73%. So you can see that the cautious portfolio gives a much narrower band of returns, and that's what it's designed to do. Whereas the growth portfolio has underperformed its targeted returns, which are inflation plus 6% per annum, but over rolling 5 to 7 year periods. The point here is that one should not be inclined, if you're invested in the growth portfolio and it's a considered investment, which would be a longer term investment with a relatively high growth objective, one should avoid the temptation to actually literally say, well, let's just switch into the cautious portfolio. Because if you look at the performance of the portfolios since inception in December 2012, the cautious portfolio has done 8.97% and the growth portfolio 11.17%. When growth markets do kick in again, you'll see that there'll be a significant gap that would actually be created between those two portfolios ideally. So the advice to our clients is to make sure that you have this conversation with your advisors, are comfortable with your long-term strategy, and resist the temptation to actually switch your strategy. This has been Jeremy Squire for Wealth Associates Asset Management.